Today I'm off to Amsterdam, Netherlands to sit down with Curt-Simon Harlinghausen. Simon and I dig into M&A, positioning companies for sale, finding acquirers, setting and defending corporate valuations, and much more. We also talk about the value of documenting everything for data rooms, as well as positioning the company for a successful executive exodus when the time is right. We also touch some of Simon's personal investment and M&A strategies. With that, please enjoy my conversation with Curt-Simon Harlinghausen. Hello and welcome to the RSnake show. Today I have Curt-Simon Harlinghausen. How are you, sir?
I'm amazing. I had an amazing week, and I'm very happy that you are here and that we have the show together. I know, it's great. We're here for a conference. Would you tell them a little bit about what that is? This is the second conference actually of this week we are organizing, and this time we are hosting for our company Miele, a conference where a lot of design companies or design-focused companies come together and exchange on challenges, developments, trends, technologies, and bring different perspectives into this group. And it's a very dedicated sort of group. It's like a closed club environment, so it's a small conference, but top-notch speakers. And I'm very happy that we were able to host that.
And you've run out of room.
And we are out of room, yeah, so we had to change the hotel twice, yeah. So it seems like our topics were wisely chosen.
Yeah, I guess so. So we are here in Amsterdam, in the Netherlands, at your house, or apartment, rather. We tell them a little bit about the building, because I think it's a kind of a spectacular building.
Yeah. Well, the time when we decided to grow into a different environment, we chose Amsterdam first place and got into a temporary place, and we pretty much grow out of that very fast. So we were looking for a building which can combine an office, can combine a community space, and also combine some housing for people coming from abroad, for some expats, but also fulfills our values like sustainability, innovation, design, high quality, which is for me like some core elements of the tradition and the heritage. Mm-hmm. So
not everyone's going to be familiar with Miele. Would you briefly explain what you do, just so?
Okay, yeah, that's a fair point. Yeah. I'm running the Miele X digital hub for Miele. So we are responsible for all kind of e-commerce data and customer engagement topics. Miele is a home appliance company, 123 years old, family owned, from two families, Miele and Sinkan. Based in Gütersloh, Germany, produces nearly everything in Germany, from steel to washing machines to dishwashers, vacuums, oven.
High-end appliances.
Super high-end. Yeah, we're on the top of all appliances. Mm-hmm. But not only by quality, also by the lifespan you can expect from our products. Like, we test them for 20 years. So durability is key of sustainability, you don't want to learn every 2 years how to use an oven. So also that is something we take care of, the aspect of the UI, UX. Durability in terms of all what is connected with each other, so that this is working well, and we have predictive maintenance and all of that already in place. So it's a very future-oriented company with a long-term strategy, not acting on short-term hiccups or influences by any economics.
Mm-hmm. You just need to make it in black, and then I'll buy some.
We have some black, and the unfortunate part is that not everything is black.
Like my soul. No.
Yeah. I'm working on that.
So there are probably 1,000 things I could talk to you about, and so choosing a topic specific to you that I thought would be interesting, and we've known each other for a decade or so, I don't know, maybe even longer, and what I landed on was mergers and acquisitions, M&A, because over just the time period I've known you, you've had at least one exit, maybe even a couple exits just since I've known you. And I also had an exit recently, so we are now kind of in a good position to actually have the conversation about that. And we'll talk a little bit about mine a little later. But first of all, would you mind telling them just a little bit about the companies that you have exited?
Yeah, the first big exit was an agency about social media, mobile, and strategy, which was founded by someone else in a very early stage, and then we fused two companies together to come to a new proposition, and then we always had kind of the idea that an exit would be a good exit also of our partnership, because we had different ideas of how business is run, but like we also had a good understanding of that we can do that together and can succeed together. And then we sold it to a company in France, stock-listed company, Publicis at this time, or still Publicis. And then I did my earn-out there. He got a warm handshake on the day of the deal, left the company, and I took over a lot of different roles within the network from Germany and the UK, and working globally in over 50 markets for them. Yeah.
Mm-hmm. That's great. So if you were to say, we're going to kind of walk through the different aspects of M&A. If you were to say what a good board of directors looks like, what's sort of the makeup, or should you even have a board? Should you run it just as a single executive and just, authoritarian, this is how it is, and keep things simple where you don't have worries about hostile takeovers? And I mean, what are your feelings about that?
Wow. If I would be a lawyer, I would say it depends. No, but in general, it's always good to have a team where you can trust on, where you can build on, where you also can lean back, because no one is a linear performer. Mm-hmm. So there are times where you face struggles in your life. So you have to rely on your team, on your partner, on your whole organization. So I'm always up for a good team. And with that, my preference is, in most cases, to have a good board of pretty much diverse people, not only from background and characteristics, also from their ambitions, as long as they all feed into the same North Star and goal. There's only one reason where I would see that a board of director could be hindering, is when you're in a really struggle time and you need to act fast to focus on the right things. You need consultants to help you to find the right North Star, but then you have to be sharp like a knife to go through the organization and clean it up to make sure you get rid of whatever is a burden. But for growth, you cannot grow on your own.
So I definitely have seen boards become extremely hostile before. Multiple companies have been involved with or tangentially involved with. Everything from hostile takeovers to just advocacy for very weird things that are totally deleterious from the company's perspective, or at minimum deriding their strategy to a point where you're actually submarining the company. The whole company is going to go down if you follow this strategy. So how do you sort of mitigate the downside of a good advisory board, or keep them in their lane and not allow them to take over the company effectively?
Depends on what, again, it depends. But like, if you got acquired and you're on an earnout, you don't focus on the future of the whole company, because that is what they suggest to you, that you should earn out and leave. So you pretty much don't invest too much time into the board. You mainly follow their orders, or you try to make the best out of the situation for yourself. And that is often the case, because it's rarely happening that the board integrates you. Like in my current role, where it's the first time I'm really employed by...
Congratulations on getting your first job.
Yeah. Pretty late, got into the game, but like, the brand Miele just got me, and exactly the board got me, and this is why I mention it. It's a family board, so there's 2 members of the family, of the founding family. There are 4 board members, but they don't have a CEO. So they have to get along and with that and come to a conclusion and come to one opinion which they express. It's not necessary that everyone has the same opinion, but they at least have one vision together and one path. And that is where I said, wow, that is exactly what I believe is a good setup. Sometimes, of course, you wish there would be faster decision making or less politics, but in general, I have to say Miele is not this driven by politics or individual futures. So it's really like driving and doing the best for the family, on the long run. So for the grandchildren to deserve a structure and build a structure which survives.
And would you say that there's a structure, a certain number of board seats that you should have if you want to get acquired, or certain makeup of a board if you want to get acquired? Like, is there a certain thing that you're like, you got to have these things? You have to have a lawyer, or you have to have a banker or something. Like, what would you say is the makeup?
Yeah, there's five roles in a board. I always suggest to have an unequal number of members in a board.
Yeah, me too.
So, and from the development side, we know that between 3 and 7, it's a good size to be managed. Also from meetings and come together and discussions and all the overhead. So 5 members is, for me, is a pretty solid number and worked the best so far. Also to get more diverse backgrounds and perspectives in. So having an IT person in with understanding IT from the scratch and the broadness, having a financial person in, not only as a financial and tax guy, but also from the legal side. Legal is becoming more and more important for organizations, and especially when we come into tech and legal, that gets really tricky. But there's so many advantages, so many treasures you can gain and open up, which is amazing. Then you need a marketing and brand person, who knows in best case also sales. It's good someone to have with a product background, understanding what you're building, product or service, whatever it is. And then you need someone being kind of the radical, being out there and having the outside-in view. Because most boards,
the innovative one.
Yeah, the innovative one, or the one is challenging you or is giving you a different perspective. A lot of boards are so focused on their organization that they don't see what's happening in the market. And how is this affecting the whole organization? I'll give you an example. One board I was in, and we were sitting together in a board meeting, and then everyone like, yeah, we got 9.7% growth. And everyone, wow, yeah, it's nearly 10%, is amazing. I said, yeah, we had 22% of the market. So we lost market share, like significant. Even if we grew, but like if the market grows faster than we do, what is the reason to celebrate? There is none.
Mm-hmm. So you've effectively lost to your competitors.
Exactly. So this is something where I think you have to bring in this. Not all board members can do that, but everyone should be open for that. But like, as we know, as bigger the company grows, it's more difficult to get all tasks into a board. Like this is something what I have seen in the past.
So when we sold, we had 2 board members, so exactly the opposite of what I'd recommend. But one of the nice parts about our board was because it was small, it was nimble. It could make decisions very quickly and very complicated decisions very quickly, as was sort of needed in that case. But one of them was our CEO, and the other one was one of our investors, the largest investor we had. And she was a woman who was entirely incentivized to get us to get acquired, which is fairly typical of a VC. I mean, that's pretty simple. But on whatever terms we want, she didn't care, as long as we were happy. Because the way her VC was set up, the only thing that she checked the boxes on is, have we done something that has been impressive? Have we, is the team good? And have we not made money yet? Which is effectively means we've failed up to this point. My friend Worley put it the best, I think. We just failed before. But we're clearly good enough to start good companies, and we're clearly trustworthy enough to start the next one because we're hungry, right? But her terms were like, I don't care what you sell for whatever you want to sell for, because I know that's going to be a good deal, whatever it is. It's not going to be a large number necessarily, but you get enough deals like that and it makes huge margins. Mm-hmm. So that was nice to have somebody with that perspective. Like, she was just helping us the entire time. Like, whatever you want, yeah. You're the boss, like, let's get this done.
Yeah, but this is the underlying message is like, I trust you. Mm-hmm. With this trust, you also get kind of a pressure, which is not too obvious, but like, you don't want to fail on the trust.
Absolutely.
It doesn't matter if you fail on the numbers, but you don't want to fail on the trust. That is exactly, if you have some principles and have these values in a company which everyone agrees on, these are our rail guards, then the trust is the fundament, and then you can build whatever you want on it. It will succeed at a time, it's a matter of time. So whether it's only, if you say you have only 2 people, and then if the board is not getting along with each other, that's a different story, but that's a human story. That's a different story, yeah. But like, aside of that is a pretty good formula.
Yeah, I agree. I thought that was interesting. And I was always just waiting for them to get the third board member, so at least they'd have, breaking, stalemates or whatever. But so what do you think about an executive team? What is the makeup, a good makeup for an executive team? If you were hiring from the ground up, let's say you're the board and you have to hire everybody from the ground up, like who would you look for? What sort of makeup?
Yeah. From my perspective, and I can only talk about my perspective here because this is where I have a real opinion on, is I always would start with someone giving me the overview of what's going on in my organization. One hand financially, other operative. So that would be the first executive person I would have in my company. It doesn't matter if it's a CMO or CIO or CTO, whatever. This is like, I would start with that role. Because if I set that right in the beginning, it will save me a ton of time and efforts, because this transparency is going all the way while growing all the way down into the organization. That will help me to show what is the decision tree, why did we come to this decision. So it's a different style, but with that style, I avoid micromanagement. And then it depends on where you go, if it's a marketing company or if it's a product company or if it's a financial company. But having a product person in, having a tech person in, and having a human resources person in is, for me, for the executive board, is key. Because I need a lawyer for my humans, whatever's in. Maybe the board is seeing only numbers, being pressured for whatever pressure comes along. Someone has to represent the human force and the team behind, and that is so key for succeeding. And at the role I have now, I have a very strong HR person. She's a real lawyer. Feels like she has 6 degrees or masters in law, in different kind, and she's really fighting for them from all different perspectives. And I like this. We have good arguments, and I say yes and no, and sometimes I try to be hard, but her arguments are so good and so straightforward that I really have to think over my decision and find a compromise. So that is good what you need. But also a product person. You want someone who's able to focus on the right things on your product. Don't get distracted. You want someone going straight away forward and build the first foundation. Build the next foundation on top of that, which stays. Then the next one. Then you get this exponential growth. This is the ladder of success. If you have someone getting fuzzy, you're lost.
Mm-hmm. So notice, kids, he did not say security, so don't get in security.
Later stage. First, yeah. No, I agree, but like security, we're discussing it, today. It's underestimated what needs to be done for security, especially coming for the future, as more and more kids, which we called hacker kids or code kids, getting to more serious, and they also need more money now when they get older. So you never know what decision they make, if they go the white or the black path. Yeah.
It definitely happens, unfortunately.
Yeah, I heard about one or two.
Yeah. So something I was talking with my CEO about, and former CEO now, a couple of weeks ago, Jeremiah Grossman, who I've interviewed on the podcast as well, great guy. He was talking about lamenting the fact that the culture that he had to create inside the company was a lot of hard knocks. Like he'd run previous companies, like White Hat Security, for instance, and learned a lot of lessons. And one of those was, you should be, friendly with the people on your staff and, whatever. But at the end of the day, you sort of have to be heartless and get rid of them when they're not performing. And truly heartless, just like, sorry, 2 bad quarters. I know you're our best sales guy up to this point. I know we're friends, and I know we hang out, and I know we have drinks all the time, and you're fired. And that's it. And if you tell them ahead of time that that's why they're going to get fired, and you're like, well, you're 2 quarters away. You're always 2 quarters away. Every quarter, you're just 2 quarters away. Then at least that's like back to the trust thing you're talking about. Like, I trust that you're going to try your absolute hardest to not fail for 2 quarters. And everyone has a bad quarter once in a while, right? It just occurs, but if you do it twice, you're gone, and that's non-negotiable. And our sales guy that we had at the time was incredibly good, and still is incredibly good. And I know that if he had missed 2 quarters in a row, he wouldn't even be upset because he knew the game ahead of time. You know, it wasn't, those KPIs were so well telegraphed at all times that, you know, he just knew what was required of him. So what do you think, you know, from a culture perspective, I'm just using that as an example, like what kind of culture do you think would be useful to sort of get to the point where you're ready for an M&A or as you're staging your company for M&A, like what would you recommend?
Yeah, as we said, there's no linear performance. Always someone has a struggle, and transparency is the key. This is why I say I would always start with transparency in a company. And then we can see if someone is performing or not. And then we say, we agreed on that. You didn't achieve it. Do you have a solution for it, or you only have an excuse? If you only come up with excuses, I cannot go on with you. Then we have to find a solution. And my purpose is, and my idea is to find that people come to an intrinsic understanding of why this is. And of course, everyone has a second chance and say, yeah, I foresee that this might come. There is an issue, but I also can tell if we don't get the issue solved within 1 or 2 quarters, then I have to have consequences. And a lot of companies are afraid of consequences because they say, oh, then the rest of my stuff will leave. No, it's even harming more the company if there is some toxic stuff or you're inconsequent, because then people think you're weak. So you have to find the right balance, but
you're weak and your company will fail. So exactly. All of those people will be out of jobs.
Yeah. And especially on young people, you need very tight rail guards. They need the orientation. They have so many opportunities, but also if you guide them, they're very happy about that. A lot of people, when they come out of school in these days, especially in the last 5 years, and with Corona even worse, they don't know what to do. So they do here and there and test, but they don't need anything. We live in such wealthy time that people are not required to work hard because they get a lot of money from the home often, not all of them of course, or they don't need this much. They need just a bed and a computer and an internet access, in most cases. And you see that, and that is changing dramatically the whole work environment.
I really, really like the idea of using the Socratic method as a cultural thing, which is to say there are bad ideas and you probably are full of them, but that's okay. Come to me with your bad ideas as long as they're slightly well-researched, as long as you feel like you're not coming just spouting random stuff to me. And I will sit there and beat them up. I'll be the contrarian until we both agree, actually that's a good idea, we should do that. But that only works, again, to your idea of transparency, it only works if they feel comfortable that you're always going to beat them up, but not fire them. I'm not going to fire anybody over bad ideas, but I will fire them if they come to me and say I've just implemented something and haven't told me what it is. And it turns out it's a bad idea. Like that.
But this is exactly the but this is the consequence, and this is the matter of being transparent. And if you're transparent, you also can fail. You talk about your fails. You talk about your bad idea, or you even ask for if you don't know if it's a good or bad idea.
I love those.
Yeah, great. And this is why I believe that, and I told this a lot to my, not everyone, but a lot to my managing team here, learn to play chess. Learn to think 10 steps ahead. Learn to think of different perspectives of your opponents or the market situation or your colleagues. Bring that into perspective and then question yourself. So step back and look at the whole situation again. And we all fail all the time. It's just a matter of how much you learn from it and how much you apply on it on the next situation. And listening for understanding is what's missing often. A lot of people listen to react, but first you have to understand if you have to react, or better you just say, yeah, thank you, it's a very valid comment, I work with that.
One of the companies that I ran across out of Austin, I believe, or maybe just one of the employees was there, they had a dashboard, I'm forgetting the name of the company, but they had a dashboard where every single person had KPIs, whatever those were. Every single person in the company, like even the janitor, it doesn't matter, everybody. And they all rolled up to people. And so there was effectively a master dashboard for the manager who would see his team were all green or some yellow or red or whatever. And some of those things were project-based, some of them were just personal performance issues or whatever. And that kind of all rolled up to a management where management could look across the entire organization and see if projects were going to slip, or they could see if people were personally performing bad in certain areas where it seems like this team is not performing very well or whatever. At a much more holistic view, without even knowing at all what any one of those KPIs were, they could just kind of at a glance look at any given day or week or whatever, however often it's updated, and just see kind of how the organization is going. So that's the transparency and granularity all the way down to the individual, especially at a larger company, is kind of rare. What do you think of that?
The company we're in, we're building exactly that.
How are you?
Yeah, there's the OKRs, the objective key results. It's not about controlling or measuring individual performance. It's more about exactly for me or the management team to get a better understanding if we're on track. And maybe we can identify any pattern where we see there's a hiccup or there's some slowing or whatever it is, and then we can support here on this stage. On the other hand, why we're doing it is we are running on an 18-month forecast. It's not that we have to do that from our mother company. It's more that we are able to plan better and more precise in terms of where we can allocate our people and our capacities to protect our people not being overwhelmed by work. So we can agree on what we have to focus on. So we have an impact and effort model that brings a scoring, and that scoring is applied on the different tasks, and those tasks come into an advanced roadmap. In our case, we use Jira, and we document everything in Confluence, which is pretty much common. And we help the organization to say, okay, this is what we have to achieve to make sure this rollout is successful, because after the rollout, there are so many people working on that. So we have to make sure we hit the timing, or if there is any hiccup coming in, we can inform people in advance, as you say, watch out, we will not manage this day, we maybe have a delay of 2, 4, 6 weeks. It could be that one individual is sick or something is happening, and then you have to react on that. And this is why we do it, and I believe it's helping everyone to get better. Our claim of Miele is immer besser, forever better. This is since 1899, the claim. So better is the enemy of good. So we believe that we constantly develop without pressuring our organization too hard, because we know what we all agree on.
I think weirdly I don't think this dehumanizes people at all. In fact, I think it really allows executives to hone in on the handful of individuals who are not performing well. And that's not necessarily a bad thing, because the way they're not performing well might be their boss's fault, or it might be
the process fault,
or a process's fault, or it might be that they're having personal issues at home and they really need a little bit more distance from work for a while or whatever. And that can allow management very deep insights into their people without having to spend as much time as would normally be required to accomplish that.
On one hand. On the other hand is what you can see there's deficits. You can train people. You know that they have the right mindset, the right ambition, the right passion, a good background, but maybe in this particular field or this task they have a deficit, or maybe they need a bit of more support, and then you can help them.
Or they're bored of that job and give them another job in the company because they're about to exit otherwise. You're going to lose a very valuable employee that you've had for 2 or 3 years just because they're bored. Give them another job.
This is why, by the way, we hire comp shaper, and that is not very familiar in most of the companies. So there are T-shapers. So T-shapers has a very broad knowledge about the business or about the environment, and a very deep going understanding and knowledge about one particular topic. Then there are P-shapers. So P-shapers have broad knowledge in 2 streams. But what we believe is, Siri wants to work with us, yeah. Now, we believe in, we need comp shaper. Comp shaper have a broad knowledge and at least 3 different fields where they have expertise. Why is this important? Especially in a younger generation, there's a bore out, as you say. After 1.5 years, they finally have understood our organization, are productive, and they say, oh, I don't like this work to do anymore. All the rollouts, all the markets, all the same. I want to do something else. And we know, yeah, was good in analytics. Now maybe he's good in implementing, or he wants to get some more hands-on and go away from theory to practice. So we have that set up. In general, we try at least 3. We go for 5. And then we see a low churn in our organization because people stay with us. We can develop them. We can give them a development path on the knowledge. And also what happens, what we have seen in the past is people with maybe 3 or 4 or 5, they wanted to develop something totally different. And they were doing it on top of their work because we gave them the opportunity. And that helped a lot also for the whole organization because people see, wow, I can develop in here. There are smart people I want to work. They develop, I have to develop. I want to develop. There is an opportunity, there's a chance, and there is support.
So in terms of the kind of company that you create, I'm talking about beyond an LLC or C Corp here. I mean, certain companies are going to end up becoming whatever. They are like lifestyle businesses, or some will become acquisition targets, or some will be going IPO or whatever. What would you do to structure your company to be specific to M&A? Is there anything like, for instance, just to throw an idea out there, like maybe not have a kamikaze business model where you're wildly spending and trying to raise another gigantic valuation every few months, or maybe that's a good idea. Maybe that would help. Like, what would you do?
It's manifold. First, the transparency will help. So whatever you build the transparency, you can use that for any kind of acquisition because then it's easy to file for a data room. So you can feed into that, have everything structured. You should be set up broad enough from your customer base that you don't rely on only a handful or 2 or 3 customers. So that is something which is key and often is a point of failure because if the one customer fails during an earnout, your earnout is gone, or the M&A deal is going to. The second is you have to make sure that you have a succession idea and plan in hand. So if someone leaves the company, whatever reasons, could be family reason, health, whatever it is, that there is no hiccup, so that the continuous development is guaranteed. Be faithful and honest with yourself and what you can achieve, and also to your numbers. As in Germany or in Europe, we tend to under-promise and over-deliver. So that is something always was good. Also, it helps if you're already on this stage where you are, acquisition target, and then you over-deliver on a nice multiple. That is something you will like, your investor will like, and that will help you over the years after the acquisition. Mm-hmm. So don't think in the moment of the acquisition and maybe the upfront payment. Think of the long term, the all over money you can make if you feel confident that you will make it. Also, what I've seen in the past is build an ecosystem around you so that you have several pillars where you stand on, that you have enough reach and partnering that is not everything relying on you. And that helps you also to have a good M&A process. Mm-hmm. And one last thing. Sure. For me, for all M&A processes, the most and the best investment I've done was in a good lawyer. Mm-hmm. A lawyer which understands the individuals of the company who's going to be sold, plus understands the business to really fight for you. But like any money you invest in a good lawyer will come back for sure.
Mm-hmm. I think if I were to add one more thing, it's being ultra consistent with your amount of money you're projecting to make, and make sure you hit those numbers, the targets, every single quarter. Ideally beat them, but at least make them. Exactly. But never, ever, ever, ever miss them. You miss one quarter, you might get away with it with your investors. You miss more than one, they'll start looking for another CEO.
Yeah, this is a very strong US perspective, because yes, in Europe we're not this black and white, and depends if it's a VC or if it's an institutional investor or if it's a family office. So family office are in general more relaxed, they have a longer perspective. VCs want to have maybe, they go for 3x, 5x, in best case 10x in a very short period. Long-term or investors or family offices, if they're not investing in funds or invest in companies, what they do is they go for 25, 50x, but they say 5 or 10 years. So they go in with smaller money in a strategic spread. Often they have a good portfolio, some favorite industries they're going in. But what I personally haven't seen too often, what is missing, and where I think from the investor side, which I'm also got into that now, is why don't investors start acting and thinking in their own ecosystems? That means if you acquire companies, why don't you build your own ecosystem which is fruitful for every member of the ecosystem? So if you say your first target is a typical branding agency, the next target should be not another branding agency. It should be an agency for performance marketing, or it should be a website, or it should be out of home, or whatever, so that those customer base can be used across the whole ecosystem. Also that everyone learns from each other. And then this creates, when someone wants to leave out of bore-out or burnout to another company, and you know it's a good person, then you have stations where they can go to. So a lot of investors, what I've seen is they focus on similar pattern because it's easier to compare. Of course, it has an administration advantage, but from the financial, the ecosystem idea is working very well.
So what kind of companies do you think are best suited for acquisition? Are they software companies, hardware companies? Are they services? What sort of, if you had to pick a company, you're like, that's much more likely to get acquired than another, industry, let's say, what would you?
Yeah, currently everything what's around number crunching and data and bringing real value out of data. So this information enhancement, I think this is something which has a huge chance. If you go to the employment market, data analysts, scientists, hard to get. It's really difficult. Why? Because people start now diving and digging into this data world and these data lakes, and they see the advantage and the value in it. So, and as often they cannot grow as fast as they want, they have to come with an inorganic growth, which is acquisitions. That could be a talent acquisition, this could be a knowledge acquisition, this could be a patent acquisition, could be a market acquisition, or could be only an additional field for their own capacities and capabilities.
Okay. So how do you know that the finances that you are currently operating with are, this company is going to be a good acquisition target? So you've started it, a couple years have gone by or however long, and you're looking at your books and you're like, yep or nope. What does that look like?
People first. I always start with the people. So I want to get an understanding how long are they a company, what is their background, and what they're working on. So if I get an understanding if those values are right, then we get into financial. So are those people really driving the right and what I can expect financials out of their work? And after that, I want to hear what is their vision and what part and what stage of their journey of their vision they are. Is they still in the build phase, or are they already in a run and evolution phase? How much do they still need to invest? What could they cut off to still survive? So also, what is their fallback scenario? Or are they only thinking in purple glasses and everything is wonderful out there? So also, are they aware of what's going on around them? And the third thing is the market ready? So if an acquisition is only on a single market or in a niche, you have to make sure that you are the number one. But only the number one is making real money. It's not the number two or the number three. So the market is also very much key.
So do you have to be making like 30% per quarter or 10% per quarter on top of what you're making before? Like, what do the finances have to look like where you're like, yeah, that company looks healthy and ready to be acquired?
What I always say is if a company has 100 employees, I expect 10% growth per quarter. If it's 50 employees, it's 20%. So as bigger a company goes, as smaller in general the amplitude is of growing, because it's more and more coordination and overhead. So I think the biggest growth per quarter you will see in smaller companies. But the continuous, the linear growth will happen when they reach a size of 100, 150 member. Mm-hmm. Because then they can predict.
So how do you find a potential acquirer? Do you just phone up your banker and start asking, or What's your process to find that's why I'm asking. Well, because some bankers they specialize in that. Yeah. They specialize in finding acquirers, or at minimum, if you already have a deal on the table, you can talk to a banker, and oftentimes they'll find you counter bids, and so you can drive up the acquisition price. So that's a real tactic. I mean, that definitely happens.
But depends on if I'm in my role as a VC or investor, my aim is not to sell it to someone who's probably paying 5 or 10% more, but where I believe that this is the best for the company. So I have some ethics, which not every banker or not everyone involved in M&A has. So I rather don't sell before I sell it to a shark. So, and also I need someone who's able to understand the business. And I have a extremely conservative bank, and for them, I'm already free radical out there. It's strange what this guy is doing and where he's connected and all the business, and they don't get what's happening on my bank accounts. No, my banker would not be the person. What I would do is I reach out to organizations like YPO networks or EO or other entrepreneurs networks, or talk to friends on my personal networks and see if there is anywhere a match or something happening in a network. Because then I don't do a cold step in, I get a warm introduction, and it's a different talk on a different level of trust. And then I can make sure, yeah, it works or works not. And sometimes it happens pretty quick and say, click, wow, yeah, this is exactly what I'm looking for. I had this just recently, and then things happen within 6 weeks.
So do you research the buyers ahead of time, or do you kind of interview them on the fly? Like how much reconnaissance do you do when you're thinking that might be a potential acquirer?
For me, it's...
Like, do you research the people? Do you research their customers? Like, do you research other acquisitions they've made?
All of that, but first, I'm not active in those companies anymore. So the people who are co-investor or co-founder or co-shareholder, they come up with an idea. And sometimes they say, it's too early, or we're not ready for that. Or I listen to them and try to find the right timing. And timing is key. And then I do a lot of stuff, to be honest, with my gut feeling. So if I understand that this is like all the different parameters are pitching together, and then this makes totally sense from a logic point of view.
Like, what would be a good example of like a good strategic fit? Where would you find like this company and this acquirer, they should meet? How do you find that bread and that peanut butter and jelly?
I'm a shareholder of a company which is doing e-commerce software development. And they have developed through OKRs, through their full transparency process, to a pretty solid business. Good numbers, good client, long-term relationship, a lot of SDA, a lot of recurring revenue. So when we were looking for, or when the time came up that those companies get acquired because the market got consolidated, we were looking for someone who exactly does not have that, where we can enhance the whole group or the whole new setup with that capability and knowledge and experience. Because with that, the whole group will profit from it and will grow in revenue and in margin and in a different way of working. But also on the other hand, we were able to access different resources, different customer bases, or even different markets, which we were not. So this came together. But like, it's not a match, it's more finding exactly the opposite of us and bring that together.
One of the things that we focused really heavily on at my previous company is we did not want to compete with our potential acquirers. So there was a line of business we could have easily gone into, and it probably would have been pretty profitable to do that, but it would have absolutely blocked us permanently from getting acquired. Like, none of the acquirers would have touched us because they're like, you guys are too much trouble. Yeah, you're competing with us on our own, with our own turfs. So, and what we noticed is that many of our competitors did go into that business. So they were kind of eating our lunch a little bit because they found this same thing that we intentionally avoided, but we got acquired, which is, you know, I think that's very telling. I think they're going to have a hard time getting acquired because of that exact reason.
Yeah. And also what you should do then is, I totally follow this idea and path, but what you should do is, like, you have to be present outside. If people are looking for targets, how should they find you? They're not Googling and say, I'm looking for this cool company. How should they know you? So you have to go on conferences, be present, present, win awards, make sure that you show, yes, the pride is right, we're ready to be taken, here, come to us. So you really have to be out there. No one's coming to your base.
Subject matter expertise, you're going to have to do conferences, blog posts. Yeah, funny, I think grand total in the entire history of the company, I think we spent $3,000 in marketing the entire time. The rest was just grassroots. It was us writing blog posts and public speaking, and which is all free. I mean, you know, just whatever your airfare costs to get there, kind of thing.
Yeah, and or you have customers talking about you. Yeah. I don't know, in the security business, maybe it's not a good idea. But in our business, or in the business of the ecosystem, I'm acting, it's good if customers recommend you. And then you get a footprint. And that will end up when customers work with other agencies or other partners and say, "Woo, who's this company?" And they say, "Oh, wow, it's interesting. Oh, maybe that would be a good addition." So this is, it's more opportunistic. But like, you always, not always, this is wrong. So often you have an issue when you go into the market and say, "Acquire me." Because people think if something must be wrong if they want to be acquired. Why? So, so create the opportunity.
It's kind of like going on a date. Like, I really want to date you. Like, you look a little needy.
Yeah, but the best relationships are just happening, you know. So I believe in this opportunistic part, and I believe there is the right time and moment where it just happens. But then you have to identify it, and then you have to act on it very focused and fast. It's not like there are so many chances.
Mm-hmm. Agreed. So when you're trying to, you know, pretty up the pig, you know, or you know, dress up the bride for the wedding, like, how do you, like, what are the things you're going to start doing to get your company looking or sounding from a marketing perspective, using the right language on their blog posts, for instance? What do you do to kind of like fluff up your feathers a little bit and make yourself look pretty?
As I said, awards is one thing, so that there is confidence in the consideration phase. Get some more testimonials out there. And then, of course, clean up everything what might be suspicious or maybe could be misunderstood. If there is something in the books, you know, you had a wrong accounting structure or whatever, people might think this is all party money. By the end, it was a trade show, and you had some.
What about the value proposition? So there's many different ways you could structure trying to explain your company. I'll give you an example. So I had this company outside Intel, which was going along and not doing anything, and I could not get a single customer, and it was just failing. And then I had a conversation with you and a mutual friend of ours, and you told me the piece of advice that ended up getting that company acquired by BitDiscovery, which eventually got acquired by Tenable, which was stop looking at your software as software and start looking at it as an API. And people can, this is just an example of what you can do. And that fundamentally changed both how I talked about it, but also how people perceived it. Suddenly their imagination went wild with all the things they could do with it. And it really changed the whole picture. And I guarantee you that company would be not even functional at all if I hadn't had that conversation with you. So like, how do you talk about your value proposition, or like get it to the point where people are looking past it to the future?
You said one thing which is key. It's not the value proposition, is giving a potential acquirer the space for the fantasy, what they can do with a company. If you're too narrow and too sharpened in your proposition, this is limiting them. If you open it up and say, what all we could do with that, what opportunities are still out there, you just trigger those and tease those, then this will like, you can see the excitement and emotion happening during the talks. And when they start, we can do this, and we have to talk to this client, and we should do this during the due diligence, then you know, okay, they're on the hook. So now we have to make the most out of it. But it's not getting narrow, getting broad.
So what about marketing? Should you say different things as you're kind of getting yourself prepared? Are there certain keywords that kind of stand out to acquirers? Or like, I always thought it would be kind of fun, I never ended up doing this, to market our company specifically to the M&A teams on like, you know, Facebook and Twitter or whatever. Just find the M&A teams that the companies I think would acquire it and just market like crazy, like every single thing is about us, just so we're top of mind. Like, I realize it's a little excessive, but.
we thought about that as well, but on the last deal, we decided not to do that. On the other hand, what we did is we gave them something to talk about us. So little stories, private stuff where they could really bond, and they could go to a colleague and say, wow, this company, this guy, and this client, and this project. So those highlights in the conversations and how we brought it to them made a difference. It's not like there's another company has XYZ on developer and doing this project with this cool client. That was this little parts that they look good. So we made them look good in the whole process, so they felt confident and happy, and this was a very easy win with that.
Okay, let's talk about the due diligence process. So let's say we've found an acquirer, we're now talking to them, and they've even started talking about a certain amount of money being transmitted, and you're happy with that offer. We'll get back to that evaluation in a minute, but what should people expect about the due diligence process? Or I think of it like a colonoscopy. You know, it is murderous. Yes. But kind of give people your perspective on what the process looks like. I mean, other than just being hard, what should they expect?
Till the moment you have signing, you die probably 3 to 5 times.
Yeah. Well, I've heard that about pretty much every enterprise sales deal. Any really good enterprise sales deal, you'll lose it 3 times, or at least twice, and you'll get it the 3rd time. Yeah. And I think the same thing is true about acquisition.
Absolutely. I was, when I sold a big company to Publicis, I was in New York, and then they said, yeah, the signing, you don't have to be on place. I said, oh, great, because then it can be in New York. And then my lawyer called me and said, the deal is done. But we didn't close it, they cancel it. I said, what? We worked like 2 years for the deal. Like everyone was like in the morning, yeah, let's go in there, and then it canceled. Some little text minor problem popped up. So stay calm during the whole process. Be confident in what you have built and what you believe on. Don't get off the path and don't get distracted. That is key for the whole due diligence. And be faithful and straightforward. Of course, you don't have to tell everything what it is there, but whatever you tell, it has to be true. So don't hide something, obviously, or don't hide anything, but like you don't have to tell everything. That is something totally different, but whatever you tell, it has to be true and has to have a foundation. And due diligence is a process where people try to get an understanding of your business. They don't try to pick your brain. So you overthink a question of them 100 times more than they do. Maybe they have something in the back of their mind, what they want to achieve, but you come up with 100 stories what they want to achieve, and you're worried so much at the end that you're like, totally great, you cannot sleep at night, and think, what did they want with this question? But actually, this question was not this important to them, but you made it up for yourself like a mountain of, wow, what could that be? So stay calm, stay on what you have built.
I like that. During ours, we almost killed the deal on our side due to one tiny little deal term. And I remember, I was actually one of the, I think it was maybe even one of the very first podcasts I did. I was right before the podcast, I'm just pacing back and forth, just, damn it, like we got so close, this is really annoying, but yeah, we're gonna have to kill this deal, like it's over. Yeah. And so we went to them and said, sorry, because of this deal term. And they're like, whoa, 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 whoa. Like we weren't that in, it's, okay, we'll change it, no big deal.
Like also you have cultural, like we had to deal with the French company, and French culture is a bit different to German culture. And with that, we had a lot of clashes. Not because of the real content itself, but because of the cultures and the communication and misunderstanding. One part was funny that we misunderstood because of language barriers in English, their offer. They thought we didn't like the offer and they give us a better offer. So we didn't even ask for that, but they put up the multiple of 1.5 times higher only because we were not understanding them. So we're like, whoa, that was a quick go. What happened here? So that was good. So we were not even thinking about that. It's just a misunderstanding. So there's so many things happening, but you really like, if you go into kind of communication with them, even if it's an email, make sure you write, breathe, step out, come back, and then send it. Don't rush, and really think as a chess player, what could that mean from their point of view?
So what about policies and documentation, source code? Like, any thoughts around that, or like what you should do to prep for it?
Yeah, if you build a software and you have a good documentation of the source code, this is a half rent. So with that, you win the deal way easier, because then people say, okay, yeah, first they believe you are the creator of the code, because you have a full documentation. They know what you have done. They know how you're structured. That is a big thing if you do software. On all the other part it's whatever you document is helping you. It's like a McKinsey. It's not like that they will look all at that, but they believe that there is something happening and is taken care of in the past. And that gives them the trust and confidence that this is a good deal. No one is reading the 1,200 pages of a McKinsey concept, but they read the management summary and believe the rest of it is fitting into that.
Interesting.
Yeah.
Yeah, I remember distinctly having conversations multiple times with my developers, like, I need an ongoing list of every library you use. And they're like, well, we don't like doing that because of XYZ reasons. And I'm like, I don't really care what you like or don't like. I've got to have it, because if we get into M&A and they start asking me about this stuff, because I was firmly believed that we were going to get acquired at some point, they're going to ask, and I don't want to have to come and rush and try to get you to do this in a hurry. I want it, ongoing. And they fought me and fought me and fought me, and then we went through this acquisition, and I'm like, okay, here's the day that we were all regretting they're not doing this, and they're rushing around and trying to figure it out, and it was really bad, because the one thing that they care about in the whole process, they don't really care what all these libraries are. They couldn't care less. But they do care about copyright issues and copyleft issues. And the problem with that is, open source is full of copyleft issues. And so you really do have to know what the software liability looks like. And so I would recommend highly making sure you keep an ongoing inventory and just make sure that you understand what the licenses are for all of that stuff. So when the day comes, you either already have a plan to get rid of the couple of things that use that particular library, or you have a very good explanation why you don't need to worry about copyleft.
Yeah, it rarely happens that you have a good explanation.
Yeah, I know.
So this is why I say start from the beginning. It's all about transparency. It's all about project management. It's all about the knowledge what's going on. And if you grow, especially on a software case, you would probably have more teams working on a piece of software with different purpose and background, which is good, because also you protect your IP on one hand. On the other hand, you can challenge teams against each other, also for documentation. So you have a documentation award for the best documentation of the month, because there is really good. So that was kind of trigger.
I haven't heard that one.
Yeah, we had, and with that we were kind of pretty good set on one deal. I said, wow, this is like a documentation we have never seen before. So the good search with a solo search behind the documentation on a Confluence structure went really good. You were looking for a hiccup or whatever it was after deployment. You found it. Our solving time was tiny.
Wow, that's fantastic. I love that.
But one more remark on that.
Sure, yeah.
But you need a dedicated person taking care of that. If no one has the responsibility for, say, I'm the master of documentation, and you keep it to the individuals, then the quality of the documentation stays with the individual capacities, will, and motivation. So the same what we have now here in this company is we have a team, it's called a knowledge success team, which makes sure that whatever comes on learning, knowledge piece, documentation is on a high standard. Visual, terminology, completeness, correctness, all of that is guaranteed. But with that, we document everything. And if there's also, it's not only an acquisition, if there is a tax audit coming in, say, what are you building there? And you say, you're building that, show me. And then you show them and say, wow, this is super professional. So any harm from any authorities will be minimized, by the way, when you say we document all of that. The work, the hours, the time.
And why we made these decisions.
Exactly, yeah.
Yeah. So how scared do you think people should be about their dirty laundry during these, I mean, this is an investigation of both corporate malfeasance or potential corporate malfeasance or tax evasion or just software liability or whatever. Like, how scared should you be? I mean,
yeah, if you start very transparent in the beginning of your organization, probably not too much, because then you can say, okay, yeah, we know that this should have been done different, but like over the last 2 years we optimized against it and we have changed it. If you know that there are some dead bodies in your basement, you really have to be thinking of, if you mention it and say, yes, this could be a liability issue. The problem is, if it happens after deal, everything is gone. The whole work you've done, whatever, your complete recommendation or the value, reputation, exactly. The reputation is gone, and that is like broad. So I personally, I want to sleep at night, so I don't want to have any dead bodies. If there is any cuts I had here and there, I go for the risk and say, yeah, but like this is normal. There's no super clean sheet in any company. I try to be as transparent as possible, but I cannot guarantee that I have not forgotten this or that. But then it's so minor that it has no impact on the business.
Yeah, I feel like for the most part, companies don't care because they kind of expect you're a smaller company, you're not going to be as mature as they are. Yes, there might be some outdated things here and there, or broken things here and there, and yes, we understand there's some technical debt, and you could have done this 5 other ways, and you chose the cheap way, and whatever. But ultimately, what they see is the vision. They see is what they're trying to accomplish, which is acquiring you and using you to do X. So as long as you don't break that, you know.
Yeah, but plus there's one thing, is the vision from their perspective, and they see the success to the moment they have acquired you. So that is something that you must have done something right. You wouldn't have got there if you haven't achieved those goals. So that they have some confidence that you have done it right in the past. Because they believe if your company is not, maybe it's 2, 3, 4, 5 years old, there is an audit, there has to be something done in the past from any authority or any customer. If you're on a certain size, they have approved that this is valid and solid. Yeah.
So do you think there's any value in doing a third-party valuation before you start talking with the acquirer and say, well, such and such big company claims that they think we're worth $500 million or whatever? Do you think that's worth spending the time and effort to do, or is it?
Yeah, I recommend that to even do that with 2 or 3 different companies to get different perspectives and arguments for yourself from a size of 20 million up. Often those below that, in general, what I would do is I talk to some people out of M&A and see what they think and what would be market value at this stage. But above 20 million, we have seen that this is a good invest. Yeah.
Okay, well, so how do you justify multiples? How do you say, well, really it's 10x or 50x, or should you try to tie your multiples to how much revenue you're making, or how would you do it for the best, try to get the best exit possible?
It depends on the stage of your organization. If you're still in a very early stage on the revenue or even a margin, a multiple would not work. But like if you say what is the potential in the market and how early you are in that field, then you can put the multiple as a fantasy, but you have to have a good business case why you believe this fantasy can come reality. As older a company gets, as more mature the financial model and the market and the environment is, you can come to a multiple which is revenue based or even better margin based. In most cases, if you want a long-term integration and not another business case or another VC case, margin is the better structure. So it's EBITDA, and then it starts from 5 to 20, and any in between Depends if you have tech or patents or what values you bring in.
I've seen high, even higher than that, like 30, even 50 in certain industries.
Yeah, it can happen. 50 is very rare.
Extremely rare.
Yeah. I have seen 27.5, which is the highest I've seen, which I thought, wow, but on EBITDA. But also because there were some other value behind, like a patent, for example, which was not monetized, or a data set which was not monetized.
So sometimes like oil rights or something that can go for fairly high multiples. Yep, specifically like very rare mineral type mines, and there's some cases where this all makes sense. And the only reason I know this is because I did an analysis on every single publicly traded type of organization across, and there was I thought it would all be somewhere between 1 and 10 approximately, and it was actually pretty wide variety. You know, consultants down at 1, and some bizarre other industries that I have nothing to do with were much higher, like 20, 30, or even higher.
Yeah, you see that in software as well, when you see that there's only a small team is able to manage the software, which can reach a broad scale and a lot of clients and turnover. Then you can see multiples from 20, 25 up even, because this is what the future brings. And they're exactly in that stage where they are in the turnaround of from the build now to the run, and this is then efficient, and then it's more harvesting and professionalizing and being more efficient in operations than just building. The building is the expensive part.
That was exactly where we ended up landing. It was right around that 20, 25-ish times multiples. And purely because we were so small and fully automated, and you know, I could add 50 people and it doesn't actually change our cost to our customer at all, or I could reduce it down to nothing and the customer is not affected. There's no humans behind the keyboard. But once you have services that do require humans, that's where things fluctuate a lot.
Oh yeah, yeah. But like there's also a high risk, and there rarely you see something above 15. Yes. If there's a good tech stack in, you can reach up to 15. But in general, you see it between 5 and 10.
Yeah. So also, you know, unique selling propositions, transferability, growth opportunities. I think these are all potential selling points for your company. Try to pump up those valuation numbers a little bit. Like anything. Talent,
huge, yeah.
Intellectual property. These are all good sort of selling points to kind of keep the people's dreams going. That this is really worth something much more. Because really, you're pitching yourself to a person. This is selling. You are selling yourself, and the sales process is all about getting people excited and thinking about how they make their lives easier or better or whatever. Are you solving a problem, or are you creating some net new awesome thing that they would like to go and engage in?
Yeah, or they even look better. It's not always like solving a problem. It's not always a negative. It's always like showing that this company is going to the next stage, is developing further, which is not only a fact for the company acquiring you or for you. It's more that for the whole workforce. They get a motivation to say, yeah, they're doing something. There we see the progress. We want to be part of that movement. We want to be part of the progress. And also what often happens, which is underestimated in acquisitions, is even if you'd say, why would that make sense? This company is not making this much of profit. Or if you come into kind of network structures, you pay a network fee being part of the network, which is maybe 10% or 12% or 9% or 5%, whatever it is. But that is the revenue, this is the interest for the network, and as long as you bring a profit and you are able to pay your network fee, they make the profit, and they find other ways to get the money out of you. So you have to book flights through a certain travel agent, and of course the travel agent puts 5 or 10% on you for the network. So with all that, they take all the money out of you, here a bit, there a bit, so they make their margin pretty much. Then they take off the overhead costs, but it's still a solid margin. Mm-hmm. And they really can base or calculate on that.
So what about the value of someone's pipeline? Let's say, you know, they're kind of going along and they're growing at whatever rate they're growing, but their pipeline's enormous. Is that something you can sort of hang your hat on to pump up those multiples?
It's always the question, where does the pipeline start? Does it start on the day of the acquisition, or start 10 years back, or 5 years?
That's what I'm saying. Or maybe different people who are further along in a pipeline, they expect to close within the next 60 days or 90 days or whatever.
Yeah, there's a propensity there often, and then you have some evidence and you show why it is. And then you have to proof point. If it's a big deal, you have to show like there is an LOI, or there are contracts sent and there is feedback on the contract. Then you can build some confidence on those pipelines. But often there is a lot of fantasy, or it's not even a pipeline, it's not even a lead. It's in an early stage of a conversation, maybe showing interest, and that's nothing you can build on. But whatever is written, whatever you have in your hand, this is something what you can build on, and then you can come up with a propensity scoring on that.
So what is something like a customer testimonial or brand worth? How do you say we have a good brand and leverage that for multiples? How do you even measure what a good brand is?
Brand health index. There are different organizations like GfK or Kantar Media, whatever they are. They can give you a good idea of how healthy your brand is, not only in the main country, but also maybe international. And that helps a lot. If you have a strong brand, which is in the target group, and not off target, of course, you have low cost on marketing. We know all brand terms are the cheapest terms. It's easier to acquire new employees. So a strong brand can help you with a lot of things. Of course, sometimes can be a burden, because you have to stick with it, and you cannot just change business models as fast, because there is a story behind it. But in 99% of the cases, I see a strong case with a strong brand. On customer base, it has to be a good mix, a good balance of income from different customers, not relying on one or two customers, so it has a good spread, and also long-term customers. What is recurring revenue from those customers? Do you have an SLA, even if it's an agency or if it's whatever? Do you have a subscription model maybe in place? Do you have access to, or do you have a long-term consent to interact with a customer and up and cross-sell? So you still have the opportunity, or it's a single sale because you only have one product. So all of that has to come into play.
Mm-hmm. So after the acquisition happens, there's usually, or in the process of it, you have to set some money aside, reps and warranties insurance, or in an escrow account. Is that a common thing in Europe as well, or is that primarily a US thing? Or?
Is it strongly in US? You see that in some part of Asia as well, to have kind of intermediate structure or escrow. In
somewhere
Europe,
around 15–20%, somewhere in that range?
Yeah, that's the same about, but like in general, you have more earnout. So in general, the upfront is not as high, and then the earnout is bigger, and with that, it's kind of if you fail or have any kind of liability, it's taken off your earnout in shares of your company. So they protect themselves by saying, in general, there shouldn't be, after the due diligence, any dead bodies. But if there is still, we get the company for free, some kind of. That is
some chunk of it.
Or chunk of it, exactly. Yeah. This is one thing. The other thing is, it's rarely happened that companies want to take over the majority in one go. Often they go and say, yeah, we want to have barely the majority and the rest is the earnout. But with that, we have full saying over the company. Not all founders are going with that path, because if I want to have the earnout, I want to have the saying. So there is the critical part, and therefore often if there's not the common sense of it, there is often an escrow built for exactly covering that case.
Mm-hmm. And then reps and warranties are supplemented with RSUs, reserve stock units, which effectively get paid out at a certain rate usually. So if the bad thing happens and it turns out you're a bad actor, not only do you not get the reps and warranties in escrow or in insurance or whatever, but you also lose whatever you would have made in RSUs when they fire you. Yeah. So it de-risks the deal pretty heavily.
Absolutely, but RSUs are not this common in Europe. So you see that a lot in US companies.
So how does it typically work in Europe?
Whether you have options, and then the options can be converted during maybe an exit or a certain time period.
Are they discounted options? Or?
Yeah, they're discounted. For often, they're on the day when you close the deal, plus a discount. And then they guarantee such growth on it, or they show that, yeah, you bring the growth into the organization, and with that, your option gets more value. But even that...
So it's mostly cash then? That's
the upside. Mostly cash, yeah.
Well, that's nice.
Yeah.
As my friend Gabe from New York likes to say, I like my cash in cash. Which is nice. You don't have to, I mean...
You have what you have, yeah.
All right, so in the post-acquisition process, how much do you personally value in reducing the company's dependence upon you as a leader? Like, how do you get the company to, because eventually you're going to leave, right? And how do you, and presumably you want your options to continue to worth something after, after you leave, and continue to grow, so it's worth keeping them around after you leave. How do you start that process of removing yourself from the day-to-day critical, decision making?
Starts from day one when I'm founding a company. Exactly. Good companies when the leader is not required and the structure and the management is able to work on their own. It's the same ambition I have here. So my ambition is not to achieve a certain amount of money. I want to make sure that this organization can run without me, or having a successor for all the different key roles. So being independent and working as an ecosystem in itself, not depending on only 1 or 2 or 5 people. So that is also the story in the due diligence. You often have to explain how does the company survive without you, and you have to proof point that. And I think there is a huge opportunity to win in a deal if you have that in place.
So how do you go about telling your team? And I think this is a funny question for a number of reasons. I was asking this question of another friend of mine the other day, like, well, how did you find out that this acquisition was happening? And he's like, well, we found out because we suddenly got shipped all these laptops from the acquirer, and everyone's looking at these laptops, and they've got the company who was acquiring them, their name all over, this box, and they all just kind of showed up, and that's how they found out. And so they weren't supposed to get them till that night when the deal had, been totally verbalized or whatever, but everyone obviously found out a couple hours earlier, which is a really kind of shitty way to find out you've been acquired.
Yeah, agreed.
So how do you go about telling your staff?
In general, what we do is we ask the acquirer if we can involve some of our key management and what maybe pretty much early stage to support, not to look too suspicious. And then we talk about partnering with other companies and bringing this partner, maybe change during a diligence, also maybe another partner which brings in a better offer. So that is not too suspicious. And then...
because the companies, for some reason, I've never really quite understood this, they really don't want the staff to know.
It's an NDA, like, it brings some uncertainty or insecurity. What's happening? They're acquiring us. Why will I have my job tomorrow? That is, of course, if you think of the side of your team, you don't want that. You want to have a continuous process, and then you can tell, hey, cool, we got acquired, and this is our vision. You want to have a story forward, and that's what you need. But before that, you have to be confident and you have a proof of that.
Yeah, but I think there's something about, like, all day long, everything's just, we're talking like we normally talk, and then suddenly one day I'm asking for a lot of documentation, and I'm asking you to fill out spreadsheets that I've never asked you to fill out because of the due diligence process. And if there's anything that's going to make someone feel uncertain, it's that sudden new crazy amount of documentation about what they do all day. It's like, wow, these people are definitely firing me or something.
Absolutely, but this is why I say start from the beginning. Implement transparency from day one, then you don't have that. Yeah. You have the documentation in place, you can shift it into a data room. People don't ask why you want the documentation, because it's coming from day one. I started here, they always want this stuff. So it's not this suspicious anymore.
Mm-hmm. Yeah.
It's not, if you start in the beginning, you have a good process and you have a good repository where you do the documentation, financial and work-wise, it's an ease. It becomes a habit.
I think that's at least partially true, or maybe even all true if you do it really well. But I just found that a lot of the questions they asked, we really needed very specific staff members to answer, because it was about what they did in their day job, and that there wasn't really a great place to document that, or at least it wasn't well observed by the executive team. You know, they don't know where that document lives. Maybe the core team who works on that part of the product to understand what's going on, they have it documented, but it hasn't trickled all the way up to executive team. So maybe that's...
The Trojan horse would be you have a tax audit.
All right, so lie.
Yeah, it's not a full lie. You don't have to say who's doing the tax. No, it's not a full lie, because the diligence also does a tax audit if you're paying all the tax. If it's helping the audit, it's another question. But yeah.
So, okay, so let's say now they know about it. How do you stop them from wanting to leave? Because a lot of people they're going to be looking at that like, ugh, I liked working for a small company. I enjoyed working with this team, and now the deck has been shuffled. I've got a new manager who I'm reporting to, and I've disappeared. I used to make a big difference, and now no one's going to even know my name. And
again, there is the human factor. If you get acquired, bring those humans in which you think is relevant for the organization, that they can start to mingle, learn about them, get in touch with them, see, okay, there's also humans. There are not kind of financial guys or infrastructure, so that there's something happening where this can grow together. Tackle and trigger their fantasy and the potential why they can grow in this new environment, and why this is better for everyone, and that's the human factor. You can tell whatever story you want. There's no human involved, people not get to buy into that. That's the emotional part happening.
So how do you continue to grow and innovate when you're in that sort of due diligence process? Because what I found in our case was we were really unable to do anything while we were in that period. We really had to, everything we did had to be documented, so every change we made had to be documented. So effectively we ended up kind of working for them as opposed to working for ourselves. So how do you kind of maintain autonomy while you're in that process, or should you just expect that you're going to be working for them during that entire process?
It's a pretty much high commitment you gave there. In the past, what we have done is we kept the company running as much as possible on the same speed and structure, because what happens if the due diligence fails and then you lose 3 months or whatever on time and work and awareness and maybe also some customers, because you focus so much on the diligence or on the acquisition. So we tried to minimize that to whatever, and if it takes 3 months longer, it took 3 months longer, but like the flow was still there. So that was a good process in the past. Also, I believe that if someone wants to acquire pretty quick, you also say we cannot do that, we want to be quick, then let me know what is the most important part, then you go only on the most important documents, and then the rest will be happening between signing and closing. Because what is the good part of that phase is you come to a financial decision together, all the framework is set, and then you have time to come up with those documents which you were not able to work on, but everything is set in stone. It's hard to push the stone over again. So that gives you the confidence, and you can talk to your employees, and this is a different story. But therefore we have the signing and closing phase where we can really stretch it a bit.
And if you're planning your exit, you and I'm sure multiple executives after their RSUs vest or whatever time period lockup they have, reps and warranties, insurance sometimes might be tied to that or whatever. How do you plan a graceful exit? Because you're not trying to hurt the company when you leave necessarily. You're just off doing the next thing. You know, maybe if you're an entrepreneur, you're probably starting another company, or just buying your yacht, you know, or whatever you're going to do.
Or your farm.
Or your farm, right? Exactly. So how do you structure your exit in a graceful way so you're not hurting the company in the process?
Documentation again. So what have I done? What did bring value? What is the economy around me and the ecosystem? And what are the stakeholders should know what information. So if you document that, that helps a lot. The second is to involve people at early stage, that they accompany you during the process, that you're not a single source of knowledge, so that you transfer the knowledge, and also that you share the vision you had to a new maybe leadership team. And also to support the leadership team in their transition. So, okay, yeah, I'm stepping out, I'm only here for making sure the team feels good and is understanding your story well. I'm kind of the advocate of the new organization, but you have to trust from the past. So that, I think you're kind of the mediator in between those, and this can take 3-6 months, but then you should do a hard cut and just get out. You can consult on a freelance base to the management team, but should not be involved in the business anymore.
Yeah, I actually like that consulting. I ended up doing that when I left White Hat Security. I continued to consult with them for quite a while, maybe 6 months later or whatever, just making sure it kind of allowed them to save face when I went to conferences, and like I'm still a part of the company, but I wasn't really, you know. So that's interesting. So we talked about this before, but just for the audience's perspective, to making sure they're caught up on this conversation. So one of the cool things I did with my company is we found out that one of the companies we were had used our software had been using it to identify corporate malfeasance from the public internet. So effectively, you could go to our software, get a snapshot of what this company looks like from an infrastructure perspective, and then continue to get snapshots over time. And one of 4 things happened. Nothing was one thing. 2 was a lot of changes, but there was no change in the assets like going away or arriving, or very minimal. It was more like services were being updated. So you could tell there was a lot of like IT hygiene issues, because some guy's running around with a CD installing stuff real quick, and which means you're going to have to do a lot of work when you get in there because they don't have the software maturity. So that's kind of benevolent. It's just, you know, you kind of realize you're going to have a little bit of problem when you get in there. The next one is they saw that there was this one particular company that was suddenly their asset count was enormous, and right after they had told them that they're potentially acquiring them. And this is a very, very, very large company, so these are billion-dollar deals I'm talking about here. And it turns out that they were basically cooking their books to make it look like they had a whole bunch of customers that they didn't actually have. So obviously that was a done deal. And then another deal, in the inverse, they saw a massive drop in the amount of assets. And what they realized is when they went back in time and saw what those assets were before, there were a whole bunch of gambling sites. And so that's where their real revenue was coming from. And so again, books were cooked, and it made it look like they were making all this money over here when it was really coming from gambling. So the only reason I bring that up is I know you have some strategies around M&A that I thought might be worth talking about. So
absolutely.
Yeah.
What I see is, and we talked in the early stage about the ecosystem idea. So I think that is one strategy which is totally helpful, to think of how could an ecosystem look and how many acquisition targets could fit into such an ecosystem that this can be managed wisely. So that this is supporting each other. The growth of the ecosystem is driven by the ecosystem itself. And that could be X growth. And I believe that is one idea. The second is, if you invest international, so you start building kind of a network of the same capabilities, maybe with different backgrounds and different strategies, but on an international base. So one in Germany, one in the US, one in the UK, maybe wherever you want to grow in. But if you have 2 similar companies, they will fight about who is the leading company. If you have complementary companies, they will learn from each other. It's easier to connect. So especially on internationalization, you should have a good mix of complementary assets in your portfolio. The third idea is finding companies which are on a certain size, 25, maybe 50 people, maybe 100, depends on the industry, where you believe, or where you saw them struggling, but mainly because of organizational reason, not because of market or product, and then acquire them, and then nurture and harvest them on a later stage, but nurture them first and bring them together and standardize your processes across all the objects and assets you have in your portfolio. Because then you have a scale effect, standards which everyone learns from, and you will see a huge impact on your assets. So we see in some of those investments we have done that there is, I think, the biggest growth potential in. Because also if you have 10, 12 targets in that investment structure, that if there are 2 failing because they were really not good and your diligence didn't show that, still the other 10 can cover that easy. And if you have really good key people, then you bring that in a different structure, take over maybe 1 or 2 clients, but like it's not a total fail.
Mm-hmm. Yeah, Jake Moylan and I talked about this a week or 2 back, and he said you need about 15 on average investments before it seems like you're going to make money pretty much consistently, and they have to be diverse. So that sounds about exactly correct. Yeah.
Yeah. Depends on, again.
I mean, if you pick good ponies, it could just be one.
Yeah, well, how could you know? Everyone tries to pick good ponies. Yeah. But I see it depends on the size. Yeah. You cannot have 15 big ones. You probably will have 3, 4 big ones, and then you have 10 middle one and 2, 3 smaller ones where you say this is a long-term bet, or this could be whatever. Yeah. Mm-hmm. So
or a pet project, or it's complementary.
Yeah. Or it's just a challenger in your portfolio. Yeah.
All right. I need you to retell a story you told me once about your wine cellar. This is a really funny story, and I think it's worth talking about.
Yeah. When I sold the wine company, my wife at this time liked one bottle of wine in particular, and I thought it was a good idea to acquire all available bottle of the year of this exactly wine. This was a...
So you went out and found every bottle of wine of this particular vintage.
Yeah, I don't know if it's every, but I tried my best across Europe, which was reasonable logistic effort to bring that in, and then they came and delivered, and we had to...
Pallets of these...
Pallets, yeah, we had to even store them somewhere outside because you cannot have them just outside, and if one was a sunny day, one delivery, so we have to get them quickly off the road before the wine dies, and it's not like a 2 or 5 euro bottle. This was a kind of a more on a $30, $40 bottle, and we stored them in our agency in the basement, yeah, so there were a couple thousands, yeah. And then a friend of us, both of us, Marcus Tober, told me, we were sitting in Berlin outside, hey, this is just this crazy stuff, and he said, oh, then he went on the platform and said, yeah, the value of the wine is like skyrocketing, went up like, wow. I said, wow. And then I started reselling the wine again, and I refinanced my wine with that. I thought, wow, this is a nice arbitrage model. I was not aware of that this exists. So I could finance my wine cooler and the wine we bought. And I went then to the winery and told them the story, and then acquired some years after some of the productions as well. And not totally, but a particular size of bottles and wine. And I really liked it. And then 1 year was not so easy to sell, and then I thought it's too much effort. But like, yeah, with that, I understood, wow, there's business models out there I've never heard of. Yeah.
Yeah.
I still have some wine.
I would love to get a bottle one of these days.
Yeah. For sure.
Just to see how much did it end up being worth after it was all said and done, do you remember?
How much I made out of it?
No, how much did any individual bottle go from 30, 40?
It went from, I acquired around 38 euro to 117. So this was the max price I received. Yeah. If I was selling more, like a couple hundred bottles, I got, I don't know, I would say 85 to 90 euro dollar, yeah.
Yeah, so double your money.
Doubling money, yeah.
Yeah, that's great. And so then you were able to restock your wine cellar for everything you sold for free, basically.
Yeah, I repeated that twice again. And the first time worked, again, very well, different winery, different wine type. The third one failed.
Okay. All right. Yeah. Failed like you lost your money or just didn't make any?
Little loss.
Oh, okay.
We had, like, I did a lot of happiness to a lot of people because I gave it away then.
Yes,
Yeah.
I see.
Yeah, but there's a burden. Yeah.
Gotcha. Okay.
Again, like keeping that wine at that temperature for such a long time in those wooden boxes and make sure that there's nothing happening, it's quite an effort. I was on the move and the life situation.
How many bottles are we talking about here?
First time 17,800.
Oh my God, I love that story. So funny.
Yeah, a couple hundreds are left.
Yeah.
Not a couple thousand anymore.
All right. Well, you got one buyer here.
Yeah.
So
I get one for free.
There you go, even better. So we talked, I don't know, maybe a couple weeks back or something about what's going on with China, and there seems, well, I'll let you tell it, but what's going on with the investors with regard to China right now?
I see a lot of institution and family office pulling out of China. It's not one or two, it's kind of a movement. Is one hand, the financial situation is pretty much declining on a highly regulated and government controlled market. So there is a lot of uncertainty where this is going along. There is a lot of tension. We don't know what's going to happen between China and Taiwan. We don't know what's going to happen between China and the US, even if there is agreements. But agreements are strange in these days. On one hand, the Ukraine is receiving a lot of drones to fight the Russians. On the other hand, the Russians do a gas pipeline deal with Turkey. So how is that fitting together? So, and the whole, it's not only China, it's the whole Asian region is getting some tension. It's not everyone is in the best shape, and we don't know where this is going to. So especially China seems to be a closed shop for a lot of stuff on long-term investments. And you don't know if you keep your investments, because the government can just take your investments and close the borders, and then what's that? And it got so powerful in an economics point of view, influencing markets by delivering key assets and goods, and that more and more investors are questioning their strategy. Yeah.
That's really interesting. So I had a conversation with Jennifer Richmond about China, and one of the things I thought was bizarre and interesting and horrible was Canada had guidance for their citizens that basically said, if you're worried about what the government is going to do with regard to Sesame credit, which is their social credit score, you should hire somebody within China who can tell you whether what you're going to be doing or not is going to run afoul of the government. So basically, get a government employee on staff, and the government employee will tell you whether you're going to lose your shirt or not. And the scary thing is that's totally correct. I mean, that is the right guidance. It's just terrible, because now you are fully beholden to the government. I mean, you are really doing what the government tells you, full stop, at that point, and they control these Canadian companies. I mean, that is the strategy.
You can see that as well in Germany. The government decided that 2 acquisition targets of Chinese investors are not allowed to go to China. The government said, no, you're not allowed to sell. So in harbors, all the big seafront harbors, you will find Chinese investors in. If you go to Djibouti, which you think now is a tiny country, but it's a very strategic point in Africa, is owned by China. I think at this time where I was there, it was 1/3 of the population was already Chinese. It was all workers in the harbors. 1/3 of the population. So taking over a country, and this is happening all around the world. So we will see China growing everywhere. It's just pure size, a very stringent 50 years plan. It's not like opportunistic for 4 years for a period of a president. So this is something is changing. This is why, to be honest, I don't want to compare that with China, but like what I like of my company now, there is a family behind it. They have a long-term plan. This gives confidence for the organization, gives confidence for the people, gives confidence for our customer, for our partner, for our retail, that we stick with our word. And that is what's happening in China, but this is why they keep the people calm. They have a long-term investment strategy outside of China. to build their pillars out there, and then they will take over here and there. Yeah. And as much as you may dislike or disagree to Trump, in that particular point, he's totally right. He is the way how he expresses it is also very particular. It's not maybe...
Not everybody's cup of tea.
Yeah, not everybody's cup of tea. But I used to live in China. I spent a lot of time there. So there are a lot of smart people with great education, with strong focus on economics and money, and pretty egomaniac because they have to survive. But as you say, the social scoring is driving this transparency. So this is a behavioral mechanism to make sure that 1.x billion people, 1.345, I don't know how many there are now, can be controlled. And we can be happy that they're controlled. If they would not be controlled, if they would run out in the world, and with their ethics of working, a lot of people here would be like, "Ooh, what are they doing? They work harder, longer, for less money. Why? Why are they? This would be scary."
Economically.
Yeah. Culture-wise, would change complete countries, societies.
So, kind of round this out, you had a pretty crazy near-death experience in a car a handful of years ago.
Oh, yeah, a couple of those actually. But I may know which you mean. You mean
the one I'm referring to. Well, first of all, it'd be good to know, just to have them tell the story a little bit. But my actual question is, how do you think that's changed you? I mean, I feel like it's got to have. I mean, you were in the hospital for quite a while.
Yeah, like the one you're referring for was a car I picked up, which was kind of my midlife crisis compensation car. Of course, it was a Porsche. I picked it up and I thought, okay, in this year is 2015, I lost my mom after 10 years of cancer. I sold my company. I had a lot of other hiccups and private issues and fighting, and with that, I came from Cologne on the way home. It was my first ride with a car. I had semi-slicks on the car, got into aquaplaning, car turned around, got hit by XC90 Volvo, and I got all smashed and broken, and my wife got out of
the car was unrecognizable.
Yeah, it was like zipped and roared and in like full compression.
I mean, if you didn't tell me that was a car, I wouldn't even know. It was just really, rubble.
Yeah, very hard to find out what color it was. Because of all the I have to say, wow, thank you Porsche for doing such great cars. 18 airbags popped up and all of that, so that saved me. But yeah, as this was not the only accident. I lost my arm once on a car accident when I hit a deer on the motorway. And you know, Germany is, they not always have speed limits on, so in general, I'm more on the faster side of driving.
You lost your arm?
Yes, you can see the,
Wow,
yeah.
That's not great.
So
clearly they gave it back.
Yeah, they gave it back nearly to full function, nearly. Wow. So nearly, yeah. Wow. But what has changed? I get more cautious, but it's not like that I now don't like to drive car anymore. I drive a very small car, which is a Polo, which is in US probably a bit smaller, Rabbit or Golf, whatever, Volkswagen VW, but it can run about 350 kilometers per hour. I think it's 170, 180 miles per hour, which is pretty.
That's fast.
It's fast, yeah. It gets me where I want pretty quick. Still like to go this fast, so this hasn't changed.
What about in business? Has it changed how you look at the world or look at business, or?
No. Not on the business side. What has changed when I was living in China, came back and I was sick and I lost a lot of money. And I had a lot of time to think in the hospital and had a lot of pain. That changed my whole business attitude. I learned how it is about negotiations, my positioning, of getting prepared, wisely enough, ask questions deeply enough, think about it, don't do a decision in the evening, do it in the morning, sleep over it, have a look on it. That was more, like this was traumatic. I was closer to death when I came back from China with all the illnesses I had than through the car accident, to any car accident.
Wow.
Yeah. But with that car accident, I drive slower in rain, yes, that has changed. And what I do since then, I evaluate my life way more. So I get more humbled, I'm more thankful, I'm less angry or worried. I'm very happy about what I have achieved in life. This has changed. Now I have 5 kids with my second wife, and we have wonderful small kids. And
a farm?
A farm, yeah. But like, what my kids, this is my wow. If I see them, my heart is like, why did I deserve to go this path? So this understanding and the thinking of karma, what I do pay in and what do I give and not expect back, this has changed, yes. It got even more obvious to me and more visual in my life, and I look way more back.
So what's next for you?
I want to be successful with this endeavor here. I want to make Miele greater as it is already. I want to make sure that I can be replaced in this organization, that I give the family what I promised, the family of Miele, and find the right balance to juggle with my family, so work-life balance, to get this in place. And then my dream and my vision is to grow my farm to a sustainable, self-sufficient environment where I can invite people to have conferences. We have guest rooms, we have a wonderful conferencing area, one up in the hill where the farm is, one down in the town, and to make an impact a positive impact on the society and the sustainability aspect. So that is our aim, and give my kids a bright future, great education, great confidence in developing, and also giving my wife the ability to do something for her after she's now investing into the kids, because I'm gone, so that we can switch positions, because that is something what I think was something I should have done with my previous wife. It was a different life situation. You have to see it as a holistic, but like, this is something what was missing, and where we got disconnected. Yeah.
Mm-hmm. Well, Simon, this has been great. Really appreciate it. Where can people reach you? How can they find you? Do you want to be found?
Yeah, you can find me anyway. If you put my name on your podcast, like
Curt-Simon Harlinghausen.
Yeah, there's not.
Got to type the whole thing.
Yeah, it's not too many people out there.
Are there other Simon Harlinghausens?
There's one Simon Harlinghausen there. This is why I used the Curt-Simon, yes. Yeah, and he was complaining about, because he owns the harlinghausen.de, and I own the harlinghausen.com, and that he received emails which are meant for me. Yeah.
And probably vice versa.
Not this often. He has not such a broad network or extensive lifestyle. Not expensive, but extensive. But I use an email address which is called s@m.de, which is very short. And so message to Sam if you want to reach out to me. I'm always up for advisory roles or any kind of exchange. I'm not looking too much into business or financial opportunities at this stage. I want to close more than I open up new endeavors. I want to focus more on my family and my life and the future, and especially on this role I have currently.
Great. Well, I really appreciate you doing this, especially at this conference. I know you took time away to do this, and I really, really appreciate it.
No, thank you very much. Thank you for your time and great conversation, great questions, and I'm looking forward for some adventures we may have together. Yeah.
Let's hope.
Yeah. Let's hope, yeah.
Thanks, Simon.
Thanks.